To set the stage for analyzing corporate debt, let's start with a history of the leveraged finance asset class, this chapter, and credit cycles, Chapter 2. Financing a company. Why use debt? Debt financing is as old as human society, although it has enjoyed varying levels of acceptance over the centuries. To choose one of many famous historical references to debt, Shakespeare's play Hamlet includes the well-known quote, "Neither a borrower nor a lender be." If all companies heeded this advice, there would be no debt markets, and thus no need for this book. While Shakespeare was a brilliant playwright, a few courses in corporate finance might have changed his one-sided view of debt. The concept of borrowing and lending dates back to 3000 BC in ancient Mesopotamia. Farmers borrowed seeds and would pay back what they owed with a share of their crops when the spring harvest came. The Code of Hammurabi, an ancient legal text, shares some of the conditions of the loans at the time. If the harvest was ruined by poor weather, the debt was void. But if a farmer failed to pay his debt for any other reason, he was forced to work for 3 years to settle it. While today we borrow and lend money instead of seeds and crops, debt continues to be a backbone of the modern economy, with most companies using a combination of debt and equity to finance their assets and operations. Therefore, an analyst must understand the pros and cons of each source of financing. The primary benefit of debt financing to the issuer is that, unlike equity, it does not require giving up an ownership stake in the business. An added bonus is that interest payments are tax-deductible, whereas stock dividends are not. In 2017, the Tax Cuts and Jobs Act, the Act, reduced some of the tax benefits of debt financing. Before the Act, companies were unrestricted in the amount of interest they could deduct. After the Act, companies were limited to deducting up to 30% of their 12-month EBITDA. After 2021, the cap became 30% of EBIT. The downside of debt is that it entails contractual interest and principal payments, whereas equity is permanent capital that never has to be repaid by the company. If a company cannot meet the cash burden of these payments, it might have to file for bankruptcy. Fundamentally, the trade-off between giving up ownership, equity financing, and increasing the probability of financial distress, debt financing, is at the core of a company's financing decisions and informs the optimal mix of debt and equity.